Does anybody have any questions about the film or the project? Yeah.
How are you funding your film?
Oh, that's a good question. Thank you for asking that. I really appreciate that. So I actually shot the first interviews in May of 2011. As you saw in the film, I started a house painting business in 2006. I dropped out of college to pursue film, and the way I thought I would do that was by painting houses. And it did work out. Like, it's all good. But I kind of saw the housing bubble unwind firsthand, and I definitely didn't predict it, obviously. But I did a torrent search for economics, and the audiobook for Economics in One Lesson by Henry Hazlitt came up. And so a torrent is a way of getting books or music. It's illegal. You're not supposed to do that. But I did that and stumbled across Economics in One Lesson, and I was painting a house listening to him write in the 40s about bubbles and crashes and the free market and everything. And it just gave me the idea that I had to track down the people who predicted this, ask them why it happened, and make this film. So Peter, you want to come on up? So like I said, I started the first interview with Peter back in May 2011, and we're finally here with the movie out. And I'm going to let him talk a little bit.
So you guys like what you saw in the movie? So how much did you charge?
Just the first 45 minutes.
All right, so you got to buy it to get to see the rest of it.
Yeah, right. The Bubble Films.
He's got some bills he needs to pay. And there's how's the other one coming?
Good. We've been so the project started as a 4-part miniseries that I tried to condense down into one film, and I just tried to do it over and over again, and just failed miserably and was never able to do it. So we split it into 2 films, which I think works out really well, as I mentioned, since people can skip to the end. Basically the first 2 films, we edited them at the same time, or we were making them at the same time. So we're just finishing editing B-roll and that sort of thing, getting a few more interviews. So we should start doing screenings next summer, at least of rough cuts.
I think you got some new footage from today.
Yeah, exactly.
Yeah, I got a secret. It doesn't have a happy ending. At least not for most people. But yeah, so what questions does anybody have for me now that you've seen the movie? Yes.
What's your idea on the effect of these negative interest rates on loans? Should a fellow be debt-free, or should you lever up?
Well, obviously, you would think that, you're getting paid to borrow money, you should borrow something. But it depends on what you do with it. Like, I hear these politicians, like the government is like, we should borrow all this money because it's so cheap. And it's like, all right, that makes as much sense as saying, there's free heroin, we should go do it. Right? I mean, just borrowing money, you do have to pay it back. Right? And so just borrowing money, because it's cheap, can get you into a lot of trouble. But if you're talking about it from an investment point of view, obviously just borrowing money and spending it, right? Buying a depreciating asset, borrowing money, to take a vacation, or even to buy a new car or a new television set, obviously that doesn't make any sense. But as an investor, like people tell me all the time, should I pay off my home mortgage? And my general answer is no. Why would you pay it off? Just lock it in, right? Just lock in the lowest rate you can for as long as you can. And because you own a real asset, even though a house is a depreciating asset, it depreciates rather slowly in general, and the land, but if you can buy an income-producing asset with it, maybe it's a piece of rental property, or if it's like I buy a lot of foreign stocks that pay dividends. If I can buy a stock in another country that I think represents a good investment value, and maybe it's got a dividend yield of 7 or 8%, and it's, the company's been around for 50 years, 100 years, and it's been paying that dividend, and I don't think that the dividend is going to go away. If I can borrow, for 10 years or 30 years at 2 or 3%, and just buy an asset that's throwing off 7 or 8%, that makes sense to do that for me. So, I would rather take advantage of that than just, own my house without any mortgages. Because if I'm right about inflation wipes out debt. Well, if you don't have any debt, then you don't get anything wiped out. But it may wipe out your savings. It's the creditor that ends up losing. But these negative interest rates are very damaging to an economy because obviously, you've got the rules upside down. Savers are supposed to be paid to save. Borrowers aren't supposed to be paid to borrow. Right? And so when you've done that, when you've turned the rules of economics upside down, you are creating some serious problems in an economy. And the consequences are going to, be, pretty catastrophic. Yeah.
You pointed out, it's in the movie, after the tech bubble crashed, the Fed cut rates, and then that obviously contributed to the housing bubble. And then after the housing bubble burst, and when the Fed cut rates, and before the housing bubble burst, they were taking credit for cutting rates and reducing the severity of what would have been a...
Yeah, I mean, they.
But then they came up with, after the housing bubble burst, then they came up with this theory about the savings flood. That it really wasn't our interest rate policies, it was all this overseas savings, which just naturally produced lower rates. I mean, what
No,
is
that
about
was.
economists
It's all
that
bullshit.
it makes it impossible for them to really...
I mean, they deliberately, when the dot-com bubble popped, they deliberately tried to reflate the market. And they wanted to prop up real estate prices. That was a goal of what they were doing. And they succeeded, but it was bad for the economy. I mean, it postponed the consequences until '08. But to say that there was just a glut of savings is nonsense. I mean, basically what was actually happening, if you really want to go back to the dynamics, we were running record trade deficits during the 2000s. And the highest our trade deficit ever hit was 2008. Now we've taken it out recently, but only if you X out oil. But because of the big production in oil and gas in the U.S., we're not importing nearly as much oil as we used to, but we're importing more of everything else. But back then what happened was the Fed was creating all this cheap money, and so people were going out and borrowing against their home equity and then buying stuff. But we weren't making the stuff. We were buying stuff made in China, made in Japan, and so we were sending all of the dollars out to Europe and Asia. And then that money was coming back into our mortgage-backed securities. So we created the glut of dollars through our trade deficits, which were then recycled. And one of the reasons that the financial crisis hit so many other countries was because all those other countries owned all that mortgage debt. Because the Fed had interest rates really low, and our trading partners were earning all these dollars. They didn't want to put them into treasuries because the yields were too low. So they bought mortgage-backed securities. So we spread this toxic paper all around the world. And when it blew up, it affected, Scandinavia because they had our mortgage bonds. But, the idea to say that it was the world, the world had all the savings they didn't know what to do with, they earned all these dollars. They had to do something with them. And they earned them because we had huge trade deficits because we didn't have a real economy. We just had this big bubble. And, the same thing is going on now. We just have an even bigger bubble. And interest rates are low because of the central banks. The central banks are suppressing them. That's what's going on. And one of the reasons, though, too, is that all of the traders know what the central banks are going to do, right? So the traders see the economy weakening. And so what do? Oh, the economy is weakening. The Fed is going to cut rates. So let's start buying bonds to profit from the Fed. So it's really, the markets are front-running what they expect the central banks to do. Because the central banks have already, made public their game plan. If there's a weak economy, we cut rates. We're going to do quantitative easing. So the markets get ahead of that. They see the economy weakening, and so they start buying bonds because they expect bonds to go up. But at some point, the whole thing is going to blow up because there isn't a savings glut. I mean, there's certainly not a savings glut in America. I mean, we have a glut of debt. We have a a dearth of savings. Nobody is saving money. So, and there's, the same thing too with the rest of the world with all these negative interest rates. Nobody is saving for negative interest rates. You'd have to be an idiot. Everybody wants to spend, right? And look at all these governments that are in debt all over the world. So there's not a glut of savings. Yeah.
Might want to fix the camera angle. Jimmy, right?
Thanks.
That's it.
Oh, what? Oh, you're filming me? Oh. Yeah, next, any questions? Any other questions? Yeah.
Yeah, after the crash, what's the trigger for a turnaround, or are we headed the way of Zimbabwe with regard to?
Well, Zimbabwe is the worst case scenario, right? And so, we're certainly headed in that direction. That doesn't mean we're going to get to that destination. Because
what stops it from getting there?
well, you have to have some fortitude on the part of policymakers to do the right thing ultimately. And acknowledge that they've been doing the wrong thing the whole time, right? They have to, stop bleeding the patient. And so someone's going to have to say what we've been doing in the past was wrong. They just can't keep doing it, because if they do, then that's where you end up. You end up in Zimbabwe if you just keep thinking the solution is to print more money, right? And so at some point we have to bite the bullet. But obviously the longer we wait, the harder it gets to do it, because, the bigger the problem is.
Do you believe that'll happen? We'll bite the bullet?
Well, I don't know what's going to happen. A lot, we'll see. It depends on who's in the White House. You have people that could be in power that don't even believe in capitalism or free markets. And so they're going to see all this as validating their belief that capitalism doesn't work. Right? They're not going to understand that it's socialism that crept into capitalism that screwed it all up. Right? So, we may make things a lot worse before we ultimately can have the type of revolution that we need. The problem is, though, when you're in a democracy, which is unfortunately what we've degenerated into over the years, but you have to convince the majority of morons, what needs to be done. And that's a difficult thing. Right? So you're going to have some politicians that are going to rise above that somehow and do things that the public doesn't want them to do, because they finally realize that that's what needs to be done. But I don't know. There are a lot of countries. You can look at countries that were very socialistic. Like, look at New Zealand. You go back, if you could find like an old, like one of these world books, encyclopedias. Older people remember what encyclopedias were. Young people don't know, because you just have the internet. Kids used to sell encyclopedias to work their way through college, before the government screwed it up with loans. But you get an old world book from the 1970s, and you read about New Zealand, and all the liberals loved New Zealand. Because it was all this government. It was like, it was like Sweden before Sweden was like Sweden, right? They were very liberal. And by the 1980s, New Zealand was bankrupt, right? The socialists destroyed the country. But then it was the left, it was the Democrats, and this guy Roger Douglas came in, and they just completely went 180 degrees the other way and started slashing government spending and eliminating departments and privatizing businesses and slashing taxes, and New Zealand thrived. And it was actually the left-wing party that led the charge, because the right-wing party never could have done it, because they would have had the opposition from the left. Like if the Republicans tried to cut Social Security, the Democrats were, you're not going to cut, But if the Democrats led the way, we're going to cut Social Security, then of course the Republicans could go on board. You can get on board with that. So you can have that. You have a situation. But New Zealand was a small country. So we'll see. You could be optimistic that at the end of the day, they'll do the right thing. But there's one thing I'm sure of, that we're not going to do the right thing until we've done all the wrong things first. right? So once they've run out of wrong things and there's nothing else they can do, then maybe they'll do it. But you better prepare for the worst when it comes to your investments and what's going to happen to the dollar.
In a case like Illinois, where the inmates are in charge of the asylum, and they're virtually bankrupt at this point, Illinois can't print money like the feds. So what happens in a case like that?
Well, what they are going to look for is a government bailout, right? Because the federal government can print money and buy up the state's bonds, right? Because the problem with the state is, and just like with Puerto Rico, where I live, where no one will lend them money anymore. But what happens is, if the federal government, the Federal Reserve, just starts buying up municipal bonds of Illinois, well, now Illinois can keep borrowing, as long as there's a lender who doesn't give a damn if they get repaid. And since the Fed just creates money out of thin air, right? They don't have to work for it. So it's one thing to lend the money that you had to earn. But if you just create out of thin air, it doesn't matter whether you get paid back or not. So, that's ultimately what everybody's looking at. And this next round of quantitative easing, which is already going on, it's probably going to expand to include muni bonds. It may even include corporate bonds, junk bonds. Because otherwise, all these bonds are going to fail. There's all these companies that should have already gone bankrupt. There's all kinds of companies that are only alive today because interest rates are so artificially low. But that's a bad thing. In capitalism, you don't want to keep money-losing companies in business with cheap credit. If companies are losing money, they are destroying value. They need to disappear. They need to stop what they're doing. They need to free up those resources to be allocated productively. If you're losing money, you are, destroying value. You're taking land, labor, and capital. You're taking $10 worth of factors of production, and you're creating $8 worth of output. So you got to stop that. The market stops that. The market rewards businesses that are profitable, that are adding value. But you got all these businesses that are losing money, that are only alive because of the cheap credit that's available. But that's being manufactured out of thin air. So the economy in the U.S. is so screwed up. And it's going to take a substantial recession to fix it. But that is the problem. What no one understands is the recession is the cure. Instead of the Fed wants to fight recession at all costs. We can't have a recession. But then we can never get healthy. We can never be cured. We can't restructure the economy unless we embrace that recession. Now, the way the government can diminish the severity of the recession is to cut spending, is to make the government a smaller drag on the economy so that the market, can repair itself. But everybody thinks, no, we got to make the government bigger. We got to spend more. We got to stimulate. But the stimulus is the problem. We're so sick because of all the stimulus from the past. Because it didn't stimulate the economy, it stimulated the problems in the economy. Right? So instead of curing the cancer, we made the cancer worse. And so now we're sicker. Yeah. Another question? Yeah.
So watching this movie, I might be wrong, but I kind of get the opinion that maybe this is all pre-orchestrated.
No one's smart enough to orchestrate it.
So my question is, when the interest rates rise, as you predict, and I suspect that they will, and it blows up all the corporate debt, is that when the government becomes the hero and nationalizes all the companies and pushes their socialist?
Well, the government, like in some of these, look at Japan, look at how much of the stock market the Japanese government already owns. That is kind of a nationalization. If your central bank just prints money and starts buying real assets, the ownership is being transferred from private hands to the government. And look, I don't know how far down that rabbit hole we go when it comes to what the Fed is buying. Right now, what they mainly buy in the U.S. is debt, and it's mostly government debt and also some mortgage debt. But that's mainly what they buy. But I do think they're going to expand the assets they're buying because they're going to try to keep interest rates suppressed. I mean, that's what you have, is you have the market trying to raise interest rates because that's natural supply and demand, and you have the Fed trying to suppress them. But the problem is, it's like that, the Apprentice, and there's a hole in and the water's coming out over here, and you plug that one up, and then all of a sudden the water comes over here, and then it's coming out over here, and eventually, you can't plug up all the holes. Because when the Fed tries to keep rates from going up over here, then they go up over there. Because they can't buy all the bonds. And so if inflation goes up to 5 or 6%, right, nobody's going to loan money at 2 or 3%, except the Fed. But then, whatever bonds the Fed isn't buying, the rates are going to go up, and that's going to create a problem. And so if they keep trying to print money, they destroy the value of the money, and then that's the problem, because the more money they print in order to buy bonds to keep interest rates from rising, the more inflation they create. The more value, purchasing power they destroy from the dollar. So by printing money to try to stop interest rates from going up, they put even more upward pressure on rates. And now they got to print even more money to stop them from rising, which puts more upward pressure on rates because they keep the base in the dollar. And then eventually, look, nobody can borrow any money unless it's from the government. But then the money loses all of its value, right? There's no free lunch. So we're going to have to pay the cost of it. And if the government just keeps printing enough money so that interest rates don't go up, then the money just loses all its value. Then you have the runaway inflation. And then at some point, if they want to put a floor underneath the dollar, they have to let rates go up. And then, they're going to go way up. And then, asset prices tumble. People default on their loans. I mean, we go through a depression or something. But I mean, that's what's going to happen. But I think if we end up getting the hyperinflation instead, it's much worse. I mean, that's the worst way to get rid of debt, is through hyperinflation. Because the economic hardship that imposes on a society is worse than just the defaults. Because at least the money still has value. You don't get all your money back, but even if you get 20 cents on the dollar, you got 20 cents, I can still buy something. If you get 100 cents on the dollar, but you can't buy anything, that's worse. Yeah.
A question for Peter and Jimmy. All of the people in the documentary, Peter Schiff, Doug Casey, Jim Rogers, Jim Grant, all of them, if I can say free market libertarians, was that a coincidence, or were those the only people we found that
No, I'll answer it first, but of course it's not a coincidence, because the people that understand economics, that people that are not Keynesians, they understand the damage that government does when they interfere. And they're also, if you're a real Austrian and you study the history of what has happened in the past, you understand why we had the bubble in the 1920s. You understand why we had the Great Depression. You have the conventional wisdom is completely wrong as to why those events occurred. So the Keynesians, or the modern day economists, who believe government is some kind of positive force, and that government micromanaging the economy is the way to go, of course they didn't see any of these problems. They don't understand. I mean, they think that the reason we had a depression was because Hoover was a capitalist and just let the free market work. And it wasn't until Roosevelt came in with all this Keynesian policy that saved us. I mean, there's such a distorted view, and the film goes into that to explain these misconceptions. And of course, all those misconceptions are driven by the educational system, by the government, the politicians, because they don't want people to have faith in the free market or capitalism or freedom. Politicians want people looking to government. They want people thinking that government is their solution, government is their savior, so they'll get their votes, right? So it's not a coincidence, and none of these Wall Street economists or none of these big economists in academia, they're all, they all believe the same nonsense. And so you're only going to get this type of forecasting or understanding from people that are way outside the mainstream. Because somebody that thinks like me, I could never get a job teaching economics at a university. I would never get appointed, to the Council of Economic Advisors. I would never get to be the senior economist at a major firm. I mean, in order to be in that position, you have to be in that mold. You have to go to the Harvard or Yale or Princeton, where you learn nonsense from a bunch of fools, right? And then you can get a PhD, in economics, which doesn't mean you know anything about economics. I mean, there are people who have Nobel Prizes that don't know anything about economics. But you have to have that pedigree, and if you've done all that, well, then you can be a top economist. But, none of your forecasting history, the fact that so many people were so wrong, that doesn't mean anything. They don't lose any credibility. I lose credibility because people say, you've been saying that for years. Look, you're wrong. Look, you've been warning about this stuff for years. I go, you can't just warn about it the day before it happens. You see these problems building, and you don't know how long it's going to take before the whole thing falls apart. But all the people that said everything was great, all these economists who right up until the financial crisis says the economy was in great shape and there's nothing to worry about, none of those people who were completely wrong have lost any credibility for how wrong they were, even the people that were at the Federal Reserve. Yet you have a guy like me who predicted it. They'll say, you were just saying that. And now, because I've been saying that there's bigger problems, well, look, see, the Dow's at new highs, so obviously you're wrong.
The idea behind the documentary was to track down people that predicted it. So when I started the project, I didn't know who Peter was. I didn't know who any of these people were other than Ron Paul. And I wasn't familiar with the Federal Reserve. I was a big fan of Milton Friedman and free trade and that sort of thing, but I just wasn't educated on the banking system. I teamed up with Tom Woods to co-write the project. So he was the one who opened the doors to get all these interviews. Otherwise, I probably wouldn't have been able to get their time. But I knew that people like Alan Greenspan and Ben Bernanke or Paul Krugman, these people aren't going to give me an interview, especially when they know that I'm coming from a free market background. And so that's why we paid to use a lot of the archival clips. And I think it works well because we're using their words to tell our story. And it really helps the audience realize, okay, we're not just saying this is what they think. We're actually using them to present what Keynesian ideas are and then refuting them. But one thing I'm really excited about is that with the second film, I think we're going to be able to reach a lot of people on the left as well, because it starts with the bailouts in 2008 and then goes on to all the other things. And so since we'll kind of get them on our side a little bit with their anti-Wall Street stuff, I think we'll be able to reach a lot more people, whereas this kind of starts with more of a free market argument and will be more effective for reaching the right. So I'm going to use this as a chance. If anybody wants to talk to me about investing in the film, the archival clips are very expensive. That's a big part of what took us so long to get this first film out. So if you want to talk to me afterwards, I'd be happy to talk. Thanks.
Yeah, and the Wall Street bailouts also served the purpose of the left, the government, because those bailouts were very unpopular, and it helped to vilify Wall Street even more because they got these bailouts. But of course, why did they get the bailouts? It was the government that chose to bail them out. I wanted to let all those big banks fail. I wanted people to have to deal with the consequences of their decisions, of their bad decisions, of their reckless behavior. Yes, the Federal Reserve was the reason they behaved so recklessly, but they didn't have to go along with the party. I mean, just because somebody is giving out free heroin doesn't mean you have to consume it. Right? And there were plenty of banks. There were bankers out there that saw what was happening and did not participate in this type of lending. They didn't get into the subprime market. They kept their lending standards. Now, of course, those banks didn't make as much money during the boom as the guys that just threw caution to the wind. Those are the bankers that should have picked up the pieces. They should have been able to buy up these other big banks out of bankruptcy. The prudent people who didn't want to party, they're the ones that should have went out in the end. Instead, they bailed out all the people that partied, and they sent the message that, hey, you got to party too. Because what's the point of being prudent Because in the end, the people that just indulge, they're not going to be held accountable. So you might as well just be reckless too. Don't sacrifice any profits because you're thinking about the long run. Just make your profits now, and in the long run, we'll bail you out, and you'll make profits again. So, but the public didn't like the fact that Wall Street got bailed out. And it actually made them more distrustful of capitalism. When bailing out failed businesses has nothing to do with capitalism. Capitalism is letting businesses fail. That's as important as letting them succeed. It's part of the process. And that's why, I don't know how many people saw my Occupy Wall Street video. Yeah, I did that with Reason Magazine, because I went down to Zuccotti Park when people were protesting Wall Street. And I said, look, you guys should be protesting the Federal Reserve. Don't protest Wall Street for accepting the bailouts. Protest the government for offering the bailout in the first place. I mean, who would blame somebody for accepting a bailout? I mean, if somebody offers to bail you out, why would you turn it down? The problem is the government never should have offered the money. Now, had the big banks not been bailed out and all these guys lost a lot of money, yes, there would have been consequences on Main Street. Okay. We needed to deal with that. But the politicians were so afraid if we let these big banks fail, it could, some people might lose their jobs. All right, well, it's better than what they did. Because now even more people are going to lose their jobs. And, a lot of the jobs that would have been lost were jobs that needed to be lost. And they would have been replaced with more viable jobs. But that didn't happen. Instead, we just inflated this even bigger bubble. And now capitalism is going to have an even worse name. And these politicians, it's amazing because they never get it. Like you watch the Democratic debates, and one of the things that these Democrats are just united about, is that we need to forgive all these student loans. That we have this huge problem. They all agree we have a student loan crisis. Oh, this is terrible. All these students have all this debt. Oh, this is a terrible thing. And the government needs to solve this problem by forgiving the debt and making college free, right? And not a single one of these Democrats ever considers the fact that it's their policies that created this problem. That without government, there are no student loans. Because without government, nobody is dumb enough to loan money to a student. They have no assets. They have no collateral. Why are there student loans? Because some idiot politicians wanted to buy the votes of kids, right? I mentioned that, people used to work their way through college selling encyclopedias, right? My father worked his way through college. All of his friends worked their way through college because they were poor. My dad grew up in a poor community. But if you weren't poor, if you were middle class, your parents could just write a check and pay for college. It wasn't expensive. It only cost money if you had no money. But then you just had a job. Nobody graduated college with any debt until the government started guaranteeing the loans. And then once they guaranteed the loans, the banks wanted to make loans to students because they were guaranteed. Why take a risk and make a loan to a business when you can just loan to some student and the government's going to pay you back? And then as soon as the kids were able to go to a bank when they're 18 and borrow money, the colleges were like, oh, this is great, let's just jack up tuition. Because the students have all this government money, we can charge whatever the hell we want. And so the colleges got more and more expensive every year, and every year this government would say, oh, college tuitions went up. Well, we better loan out more money to the kids so they can pay the cost. And then all of a sudden, college became so expensive that the only way you could afford it was to borrow money. And that was perfect. That was exactly what the government wanted. Because now they can get the votes of all the students. Because they can promise, well, you got to go to college. Vote for me. I'll make sure you can borrow the money so you can afford to go. But if it wasn't for the government, you wouldn't need to borrow money because the prices would be lower. So the politicians come in and they create a crisis. They took something like a college degree that was actually very inexpensive to get and had a lot of value in the market once you got it. And basically what they did is they simultaneously destroy the value of the degree, because now everybody has one, and they cause the price to skyrocket. So now you have to pay a fortune to buy something that's worthless. And you end up graduating with a pile of debt. So the government just created this entire problem. And now they say, oh, you see, capitalism doesn't work. Now we have to make college free. Well, if you think college is expensive now, wait till you see what it's going to cost when it's free. Right? But this is, the government never learns. Right? So they just, so we'll see what's going to happen. A last question? Yeah.
I just got two questions. One, as we are obviously getting closer to this problem, do you think the allocation for physical should be still 10% or 3%?
Well, I mean, look, I think the odds of gold going down are slim. I mean, going down by any meaningful percentage at this point. So, gold's going higher. All interest rates in every major currency adjusted for inflation are negative. So, and you have central banks telling you their goal now is to destroy the value of their money. Every central banker wants at least 2% a year inflation. So they're telling you, if you hold on to our currency, you are going to lose value every year. So there's really no reason at this point to save any currency. So any savings that you want should just be in gold, right? But as far as investments are concerned, are there better investments than just buying a bar gold and putting it in a vault? I think so. And I think gold mining companies, which have been pretty bad investments over the last decade or two, I think are going to end up being very good investments when the price of gold really goes up, and now they can make a lot more money mining it. But there are a lot of other investments. But I think that where we are now, excuse me, inflation is going to wipe out a lot of savers. You have to recognize, that when you have all this debt that can't be repaid, somebody is going to lose, and it's going to be the creditors, the people who are owed money, who are not going to get repaid. Either they're not going to get their money, or they're going to get money that doesn't buy anything. So you want to have a higher allocation to real assets. You don't want to just have a portfolio of bonds, right? The people who are going to lose the most are going to be the creditors, the people who are just owed paper, right? You own a bond, you have an annuity, a fixed annuity, you have cash value in an insurance policy. This is where the biggest losses are going to be. So you have to guard against that. Was that both your questions?
No. Do you think the mining share appreciation outpaces the loss in value of the currency?
Yeah, rather dramatically so. Because, you take the price of gold, let's say the price of gold is at $1,500, and let's say the price of gold goes to $10,000 an ounce. Well, the cost of mining gold is probably going to go up too. But let's say a company, right now, their costs all in is $1,000 an ounce, and gold is at $1,500. All right, they're making a certain amount of money, but they also may have a lot of lower grade deposits that cost $1,600, $1,700, $1,800 an ounce to mine. That gold is worthless. They're not mining it, right? It's not being, assigned any value, because there is no value at the current price. But if the price of gold goes up to $10,000, but the cost of mining it maybe only goes up to $3,000, there's a lot of value there that didn't exist. But the other thing that's also going to happen, if you look at the market cap of all the gold stocks in the world, it's tiny relative to the overall stock market. And if you compare the market cap of all the gold stocks in the world to what the historic average is for gold stocks relative to the rest of the stock market, it is historically ridiculously low. So, what's going to happen is when gold goes up and these gold stocks really start to make a lot of money, you're going to have a lot of portfolio managers that have no exposure to gold stocks suddenly deciding that they need to have exposure to gold stocks. And so that's going to make the shares go up in price more than just their earnings going up. People are going to be willing to pay more to get exposure to that sector. So nobody really owns these stocks right now. I mean, other than, diehard gold bugs at this conference. I mean, your typical mutual fund has no exposure to gold stocks. Your typical pension or, just endowment, there's no gold stocks there. And so once those allocations are being made, and it's all like a herd, right? Nobody wants to be the first one to do something. Nobody wants to stick, go out on a limb, because everybody is worried about, doing something different and then being wrong and then getting fired or whatever. But once everybody's doing it, well then, there's comfort in that and people will do it. So I think the gold stocks are going to have a tremendous move. I mean, obviously not every stock, and some stocks are going to move up more. That's why I say, let Adrian Day pick your stocks for you. Get into my gold fund or get a separately managed account so that you're in the right stocks. Because there's going to be a lot of scams out there, especially as the market really starts to heat up. And everybody's going to want to be a gold stock, just like at one time everybody wanted to be a .com stock. Right? What is the definition? What's the definition of a gold mine? Is a hole in the ground with a liar standing next to it. So you got to make sure that when you're getting into a gold mine, there's actually gold in the mine. All right, good. I'm tired. I gotta go to sleep. I've had a long day and I have this bad cough.